と、
All right, let's dive into the world of Canadian income trusts. For a long time, these were the absolute go to for investors who wanted high, tax efficient income. But then everything changed. A massive rule change completely reshaped the landscape. And understanding that shift, well, it's absolutely crucial if you're looking to invest in this space today. So here's what we're going to cover. We'll kick things off with the basics. What are these income trusts anyway? Then we're going to unpack the SIFT rules. That's the part that changed everything. We'll also look at REITs, which are a really special case. And of course, we'll get into the nitty-gritty of distributions and risks and wrap it all up with a solid framework you can actually use for your own analysis. Okay, first things first. What exactly is an income trust? If you look back to the late 90s, maybe the early 2000s, these things became incredibly popular here in Canada. And the appeal? It was really simple. They offered a way to get a high, steady stream of cash from a business and, the big kicker, with some pretty significant tax advantages. So at its very core, you can think of an income trust as a special kind of container, a legal structure designed to own an operating business. But instead of shareholders, you have what are called unit holders. The whole point, the primary objective, was to take all the cash that business generates and pass it directly to those unit holders. And historically, this meant bypassing a huge layer of corporate tax. That was the magic. And this chart here really breaks down how it works. It's a pretty neat system. Step 1, an existing company takes its cash-generating assets and puts them into a trust. Step 2, that trust turns around and sells units to investors like you and me to raise money. Then, the cash from those assets flows up to the trust, which, you guessed it, distributes it right out to the unit holders. It was literally a direct pipeline from the company's cash flow right into the investor's wallet. Now, it's super important to get this. Income trusts isn't just one thing. It's a really broad category. For instance, you've got business trusts. These might own something like a chain of restaurants. Then there are energy trusts, which own oil and gas assets. Their fortunes, as you can imagine, are tied directly to commodity prices. And then you have the big one, real estate investment trusts, or REITs. They own huge portfolios of properties and are, frankly, a dominant force in the market today. Okay, now we get to the turning point. The event that completely, fundamentally altered the entire universe for these investments. See, by the mid-2000s, the government started getting pretty worried. They saw more and more companies converting to trusts, and that meant the corporate tax base was eroding fast. So what was their response? They introduced something called the Specified Investment Flow-Through Rules. We just call them the SIFT rules. This timeline really puts it all into perspective. The late 90s and early 2000s, that was the absolute golden age for income trusts. It was all about that tax advantage. But then, bam, October 31st, 2006. The government announced the SIFT legislation, and it changed everything. It phased in a whole new tax system that basically leveled the playing field, making most trusts look a lot more like standard corporations from a tax point of view. Just look at this comparison. The difference is night and day. Before SIFT, you had this beautiful system where income flowed to unit holders with very little tax at the trust level itself. But after SIFT, the government imposed a new tax right at the trust level for most of them. And what that did was make their distributions feel a whole lot more like regular corporate dividends, tax-wise. I love this quote. It's such a perfect way to think about it. Remember that direct pipeline we talked about? From the business right to the investor? Well, it wasn't shut down completely. Instead, the SIFT rules basically built a government toll booth right in the middle of it. So now, a big chunk of that cash flow that used to go straight to investors had to stop and pay a toll that went directly to federal tax revenues. But wait, the story doesn't end there. Not at all. The government looked at this and recognized that real estate investment plays a pretty unique role in the economy. So they carved out a major exception in the SIFT rules. And that one exception? Well, that's the reason why real estate investment trusts, or REITs, are still so prominent today. So what is a REIT? It's pretty simple, really. It's just an income trust that specializes in owning a portfolio of income-producing real estate. Think office towers, shopping malls, big apartment buildings. And here's the key. As long as they play by a very strict set of rules, they get to keep that amazing tax-advantaged status and avoid the SIFT tax altogether. Okay, so how do they get to keep this special status? It's not automatic. They have to pass two crucial tests. The first one is called the property test, and it's pretty straightforward. At least 90% of their assets have to be actual real property. You can see why, right? The government wanted to make sure this tax break was for real estate companies, not some manufacturing plant trying to pretend it's a REIT. And the second hurdle is the revenue test. For this one, at least 75% of the REIT's gross revenue has to come from core real estate activities. We're talking about things like collecting rent, earning mortgage interest, or profits from selling a property. Again, the whole point is to keep them laser-focused on being a real estate business. Okay, so let's get to the bottom line here. It doesn't matter if you're looking at a trust that pays the SIFT tax or an exempt REIT. You absolutely have to understand what you're actually getting in that distribution payment. And just as important, you have to get a handle on the risks you're taking on. Because let's be honest, a high yield means nothing if it's not sustainable.
A really common mistake people make is thinking a distribution is just one thing, like a dividend. But it's not. In reality, it's usually a blend of different things. Part of it might be taxable income from operations. Another chunk could be capital gains if they sold a building. And often, a pretty big piece is something called a return of capital. And guess what? Each of those pieces has its own tax treatment.
Let's zoom in on that return of capital, or ROC, for a second, because this is really important. When you get a payment that's classified as ROC, you don't pay tax on it in that year. Instead, what it does is it lowers your official purchase price for tax purposes. We call that your adjusted cost base. So don't think of it as tax-free money. Think of it as a tax deferral. You're basically getting a piece of your original investment back now, which just means your capital gain will be bigger down the road when you sell. And believe me, the risks here are very, very real. The number one risk? A distribution cut. These payouts are not guaranteed like a bond payment. Then you have risks tied to the specific industry. Energy trusts? They're completely at the mercy of oil and gas prices. REITs? They're super sensitive to changes in interest rates. And of course, there's always the political risk that the government could just change the tax laws. Again. This chart is a perfect, if painful, illustration of that danger. Let's imagine a hypothetical trust, ABC Energy. When oil prices were high, they were paying out this massive distribution. But what happened when oil prices collapsed? Their cash flow completely cratered, and they were forced to slash that payout by 75%. So all those investors who bought in looking for stable income, they watched both their income and a huge chunk of their original investment just disappear. So, how do we actually apply all this? Well, given how complex this stuff can be, just chasing after the highest yield you can find is a total recipe for disaster. What you need is a disciplined, analytical framework, and that's exactly what we're going to build next. All right, here is a solid step-by-step checklist for your due diligence. You start with the basics, like confirming its SIFT status. Then you got to dig into the financials. Is the cash flow actually stable? Look at the management team. Do they know what they're doing? And then you have to stress test it. What happens to this thing in a bad economy? Ultimately, it all comes down to scrutinizing the sustainability of the cash flow. That's what supports the entire structure. And when you are digging into those financial statements, these are the metrics that really matter. Honestly, you can almost forget about things like earnings per share. Focus on free cash flow. That's the real cash left over after all the bills are paid and investments are made. Then, calculate the coverage ratio. How many times can their cash flow cover that distribution they're promising? If they're generating $1 in cash and paying out 99 cents, there is zero margin for error. So let's wrap this all up. The landscape for Canadian income trusts has changed for good. The golden age of easy tax avoidance is long gone. But, and this is a big but, for investors who are willing to do the homework, for those who prioritize the quality of the cash flow over just a sexy headline yield, a well-structured trust, especially a REIT, can still be a really valuable part of an income portfolio. So I'll leave you with one final critical question to ask yourself. The next time you see an investment promising a really tempting, high, steady payout, I want you to remember everything we've talked about today. I want you to look right past that tempting yield and ask yourself, what could go wrong here? And have I really, truly stress-tested the cash flow that's supposed to back this all up? Answering those questions, that's the very essence of smart, prudent investing.